It's like a race car driver and the car. It's two things that always have to be kind of moving together in order to win a race.
If you're wearing the right type of camouflage, there's your edge, right? But if I put you in a different environment, there goes your edge.
Again, it's understanding where we are within the cycle of that stock's movement.
If your setup is based on supply and demand, then there will be no edge erosion.
Hello everybody, this is Anthony for Investors Underground, and today we have a special episode where I'm joined by a number of exceptional traders and moderators within the Investors Underground community, and we're going to be having a discussion about the topic of edge erosion. Does it exist, and if so, in what capacity for traders? I'm joined today by Chris, Nick, Stan, and Ariel. Guys, thanks so much for being here and being willing to have this discussion with me.
Looking forward to it.
Absolutely. Yeah. Thanks for having us, Anthony.
Absolutely. So online, I'm sure you guys have seen a number of comments or criticisms about particular strategies in the market, and the topic of edge erosion comes up. People saying that edge erosion is the reason either why they don't share their strategy or warning people about edge erosion in the markets. And so as you're all members of Investors Underground, where typically you're sharing your ideas, your thesis through watch lists, your edge to some degree is being shared with others. So I want to ask you guys, what's your take on the topic of edge erosion? And do you ever worry that it's going to possibly reduce your profitability or your longevity in trading? So I'm just going to toss it out there for you guys to, let me know your thoughts.
Well, from my perspective, in particular as a swing trader, I actually believe that, edge is, it comes down a lot to my personal risk management. And, if I'm looking at a particular setup, whether it's an earnings gap up, it's not so much that I know an earnings gap up works and works well with good fundamentals and you get a big breakout of a base. It has a lot more to do with where we are in the market cycle, right? If I see, a company beating on earnings, top and bottom line, and, they are coming out of a multi-month consolidation, I'm not the only one that's seeing that setup, that edge, right? Whether I'm a buyer of a 1 minute opening range break or a 5 minute opening range break, sharing that with people, in reality, it's actually a timeless setup. So I'm not too concerned with sharing that quote unquote edge with anybody, because I do know that it is a timeless entry, right? But where you are in the market cycle, right? Where this particular stock might be in its bullish trajectory, whether it's been a 18-month, 6-quarter long earnings winner, right? The edge might not be there on the 6th quarter and a second or third or fourth earnings gap up as it was a stock that's coming out of a big long base. So when I think about edge, really it's not so much that the edge itself within the setup is eroding. It would only be eroding because of where we are within that stock's market cycle, and then even where the health of the industry group and the market itself, where we might be. If I'm trading a NASDAQ stock and the NASDAQ, the QQQ might be up 70% over 2 years, it's less likely as a stock has been on an 18-month run that edge does erode. But it's understanding where we are within the cycle of that stock's movement that creates set edge, right? So if it's a fresh earnings play and it's a stock coming out of a big 3-month, 1 year long base, right? It's a forgotten group. That helps a lot, right? Stocks that have been dormant, groups that have been dormant, and then you get a stock with really great earnings and sales, and then you get another great stock with earnings and sales, all within the same group. Being there to buy that earnings gap up is a timeless setup, right? It works often. But when you're in a, 18-month run, call it a Palantir, up $100 effectively, and it's already had multiple earnings gap ups, that, in my opinion, is the only time that your edge begins to dissipate talking about that setup. And again, it's just understanding where you are in the cycle. It's not so much that if I just share my quote unquote silver bullet, that it now won't work. So that's kind of how I've always felt about, whatever my particular setup is. Sharing it with the world doesn't mean that it's going to stop working. Institutions aren't looking at me and saying, oh, Ariel likes earnings gap ups. We're going to just start crushing earnings gap ups because he just shared it with everybody and we can't have anybody making money, right? I think that that's a total fallacy. But buying the fourth earnings gap up, right, after a, quarter over quarter beat, at some point that edge does begin to erode. And it's not because I shared it. It's because, where we are in the market cycle, where the stock is in its market cycle. But if you're on early with an Abercrombie and it's really tight against its 200-day and they have a surprise earnings beat, right? They gap up on earnings, you buy that earnings gap up, and then it goes for 6 quarters. And so there's edge there, right? And to buy that opening range break, a 5-minute, a 1-minute, a 15-minute, a 1 hour over pre-market highs, whatever it is that your entry is where you feel you can limit your risk. But it's not because I shared it with the world that it works or doesn't work, right? A BlackRock or a Fidelity or a State Street or a local hedge fund or Stan Druckenmiller, nobody cares that I 15,000 follower account on Twitter shared it with the world, right? Or a moderator from IU, right? That's not their concern. Good earnings and sales early in the stock market cycle, coming out of a bear market, potentially for the market, even better. And then that's where a bunch of edge lies, right? 6 quarters later, that edge starts to erode, not because I'm talking about it, but because of the market itself.
Okay, and for Stan and Nick, I know you guys tend to short and take the opposite side of that on something, maybe it's, a large cap or something that's like a theme stock running, or for Stan, maybe it's a small cap stock. Do you guys ever worry about edge erosion? Maybe more people are seeing these types of strategies. Do you worry about what you're sharing, and are you seeing any sort of decrease in profits,
Right,
or edge for you?
For me, Anthony, I think I'll go back to that whole statistic of 90% of traders fail, or 95, and then only 5 succeed, etc. For me, I think that ties into the very early stages of edge conversation, right? Because I firmly believe that statistic is a little bit lopsided, and it's not that 90% fail, it's more so only 10% try and give it their all, right? So looking at it from that point of view, for me, edge erosion is not necessarily a real thing. Because if the setup is truly based on market structure, which market structure is supply and demand at its core, that's what market structure is, right? Supply and demand. If your setup is based on supply and demand, then there will be no edge erosion because there is plenty of liquidity, right? If you take, as an example, like an EP setup, everybody knows about an EP setup, and they continue to work. They have worked, and they continue to work, and they will continue to work in the future because the EP setup, EP is the definition, right? That's just the definition. But what does the EP setup define? It defines a particular opportunity within a particular market structure that supply and demand may now be in balance, so it provides the opportunity for you to take advantage of that. But the reason why I believe edge erosion is not necessarily the crux of strategy dying out or a setup not working anymore, it's not because of the edge erosion, but more so because the cycle has changed. You no longer have the same fundamental market structure in supply and demand underneath, and now it's no longer working. There are particular setups that are very much not fundamental based, but they're very much technical based, right? So when something is technical based, then if you introduce more flow to it, that technical trigger gets crowded, but the setup doesn't disappear. The only thing that happens is it shifts in time. So maybe something historically, it used to take 3-day run up and then it fail. Well, as that particular setup gets introduced, because it's solely based on a technical side, not a supply and demand, now the 3-day may extend to a 5-day run-up and then it fails. Does that mean that the setup is eroded and it's gone? No, it doesn't mean. What it means is you have to account for that extra eyes. You have to account for that extra volume in what you're looking for, because the underlying aspect of market structure, supply and demand, that doesn't change. That doesn't change it doesn't change in terms of who knows about it, how many people trade it. That's why I have been attracted to trading for so long, and it's one of the biggest reasons for me in trading, being in trading, is a true strategy is scalable. What you trade with 100 shares, Chris can trade with 1,000 shares, Ariel can trade with 100,000 shares, and Nick can trade with 1,000,000 shares. And that setup will not change. Take as an example the PLTR, Palantir blow-off that we had recently, mid to late February. We also had the SMCI run up into their catalyst. So all of that, right? All of that market structure is the same. It has been the same for years, and it will continue to be the same for the next several years, right? So I think edge erosion really has to do with a couple of things, right? If you don't have enough setups, if you don't have enough strategies in your tool belt, when the market shifts, it will feel and look like, oh, the setup is eroded, too many people are on it, it no longer works. It must be edge erosion.
Right. Yeah.
And I'm here to say that in some aspects, if it's really technical, take for instance the China liquidation type of plays, when it's severely technical, the technical component could get crowded. But the China liquidation plays, they still exist today. Maybe now they go from 2 to 3 to 5 to 10 and then fail, whereas before maybe they just went from 2 to 5 and then failed, right? But the failure aspect of the China liquidation names, that is identical, because it's just selling volume. That's what selling volume looks like. It could be in a China play, it could be in Palantir, it could be in SMCI. When you have a big dump of shares, it looks the same.
If you're enjoying this conversation with some of the Investors Underground moderators, then Investors Underground just might be the place for you. You'll have access to courses and mentors to learn from, some of the best technology available for scanning stocks and breaking news, and access to the chat rooms where you'll find a vibrant community of focused traders who share their trade ideas in real time each day. Members also have access to the morning broadcasts where the IU moderators share their trade ideas for the day ahead during the pre-market session. Members have access to the midday study sessions with Stan, the midweek study sessions with Sam, webinars, moderator watch lists, and all the other resources and tools that Investors Underground has to offer. Listeners of the Trader's Journey can access exclusive membership deals available at investorsunderground.com/journey. And now, back to our roundtable discussion about edge erosion. I think it's a great point, especially the topic of adaptability, because it sounds like, and correct me if I'm wrong, but don't mistake for edge erosion what can be attributed to a possible change in markets.
Correct.
Right, and that's one of the reasons why an episodic pivot. When you say EP, for those listening, this is a reference to episodic pivots. They have maintained their ability to be, to be successful year after year, decade after decade.
Because they're based on a very fundamental aspect of market structure, supply and demand. You can't change that, right? It's supply, that's a mathematical formula that's what it's based on. Now, if your setup is based on the moon phases and it's based on when Mars aligns with Jupiter, I can understand. Maybe that gets crowded. Maybe not everyone can execute on that. I can understand that. You can probably erode that. However, if your setup is based on true market fundamental structure, it will remain there. What changes is the time, right? What changes is the volume, perhaps, the range, the volatility. All of these technical components of a setup, they are malleable, they do change. And that's where your strength as a trader comes in form of adaptability. The quicker you can adapt to the changing variables, the faster you will be there and the first in line you will be, right?
Yeah.
And that for me is something that I keep in mind when I trade a particular setup, large cap, small cap, whatever, right? if the setup is not working, I go back and I say, there's two possible reasons why this setup is not working. I messed up, market changed. That's it.
Yeah.
And it's generally, guess what the answer is? I messed up. That's generally the answer, right? But in times, market do shift, like the market changes, the cycle changes, and you have to adapt for that. If you don't, it's gonna feel and look like someone eroded your edge.
Yeah.
And that's not it. You know, for me, edge is self, right? Edge sits here. Because you and I are exposed to the same opportunities. Maybe you take it, maybe I don't. Why is that? If the edge is provided by the market, then it makes sense that when this particular setup comes, everybody should take it that knows about it.
Right.
But that's not the case.
Yeah.
Because the edge, right, how I execute, how I approach a position has a lot more to do with who I am as Stan versus who I am as Godfather the trader.
Mm-hmm. And it's hard to admit that you're wrong. Anybody who's traded well, probably gets that sense.
I'm wrong more than I'm right. I guarantee you.
Yeah. And Nick, where do you jump in here? Where do you fall?
Yeah, I mean, I pretty much agree with everything Stan just said, but I really do think that it comes down to adaptability, right? Like the market's constantly changing. Yes, there are certain setups like you guys went over that don't change, right? Earnings winners, breaking out of a strong base on volume, like that's a setup that's not going anywhere. But at the exact same time, I think that the people that talk about edge erosion, for the most part, they're talking about, a system that they used to, a process that they used to have, and now it's just not working as well, or it's taking a little longer. And to me, that's just adaptability in the market. And you constantly just have to adapt to your surroundings, right? It's like, it would be like, putting on camouflage to go hunting. And if you're wearing the right type of camouflage, there's your edge, right? But if I put you in a different environment, there goes your edge. You have no more camouflage anymore. So it's like, you really have to adapt to the theme, the sector, the market. Like, I don't think your edge is gone,
really good
right?
analogy.
You just have to adapt to it. And yeah, I mean, all these setups, they're not going anywhere. The market doesn't really change the way people think it changes. People are still human, and it's all based off of human instinct. So yeah, I think when it comes to edge erosion, it's not really a real thing, and it comes down to adaptability and really expanding your repertoire, right? Like Stan, you were talking about, like your toolbox or tool belt. You need to have different areas where, like, okay, this part of my process is not working right now, but I do have another process that this is a perfect setup for, right? Mm-hmm. So you need to have a tool belt. You need to expand your repertoire. And I think if you're complaining about edge erosion, you're just not doing a great job at that.
Mm-hmm. Yeah, and Chris, since you trade options, what's the discussion like around edge erosion amongst options traders? Is this something that people spend a lot of time thinking about or arguing about?
Sure. So, I mean, especially with options, I feel like as options have become more, more of a driving force in the regular markets, that has changed things. So, the concept of edge erosion is like, what is edge and where does edge come from? Edge is something that makes a trade non-random and puts it in your favor. And that can come from the particular setup itself. Or it could come from yourself about how you are trading many different setups. So, I mean, any kind of setup, it's just like Stan was saying, supply and demand interacting in a particular way. And the way that those things interact might change a little bit over time, and you have to adjust to those changes. But that is where, trading is not just about a setup. It's not just about the person. It's like a race car driver and the car. It's two things that always have to be kind of moving together in order to win a race. And so for edge in a setup, you need something that has positive expected value, and that's based on how supply and demand are interacting. And then it's about how you're interacting with that setup. And so it's two things there. And I think, something that Nick said reminded me of a quote. I think it was after atomic weapons were introduced, and Einstein said that this changes everything except the way that people think. And it's saying that, like, the form of whatever it is can change, and things can, become exponentially more reactive or options can get introduced, or you can have, scams that are introduced in the market or anything. But at the end of the day, supply and demand, greed and fear, those are all going to cause imbalances, and it's up to a trader to identify a structure that has an imbalance, and then it's up to them to, decide how they want to participate in that. And so, if someone's only edge is based on a statistical setup that they've tracked, but they don't understand why it's happening, and they don't understand that, due to market cycles and everything else, things fluctuate and the form of that looks different over time. If that's their only edge, then that can be eroded. But if you're coming at the market like a true professional, where you're not just focused on the setup, but you're focused on the overall understanding of supply and demand, and then how you have to change and adapt to that, I don't think that there's edge erosion in that. And that's why, traders who've been around for a long time are still able to do that. We were joking beforehand, Warren Buffett's had a public strategy that's worked exceptionally well for 70 years. Where's the edge erosion? It's not. Has he had to change the way that he looks for businesses? Has he had to change the way that he defines what value is? Yes. But that doesn't change the fact that he's a business investor looking for wonderful companies for a long period of time. And it's the same thing with the trader. You're looking for wonderful setups with huge supply and demand imbalances that you're looking to capitalize on. And so the form of that might change, but the edge of finding that doesn't change.
Yeah, that's a great point about the why. Why is it happening? Why do you have edge in a particular strategy or setup? What would you guys say to someone that complains that, maybe my edge is that I trade small cap China stocks, low float, and my edge is being eroded because there's only a limited number of shares available for me to get, right? More people are trading these, and so I'm worried about my edge eroding because there's too many people trying to secure shares to short in something like that. What would a response be?
Yeah, I mean, I obviously believe that, if a company's got a low float and you've got enough big players who want enough shares, right, and cause a big demand imbalance within the stock, right, that can obviously take it higher. Once options are introduced into particular names as the theme becomes hot, even in quantum stocks, when they were super cheap, they didn't have options available, and then an option chain does become available for some of these names, right? Then the supply demand imbalance becomes different as well. And so kind of understanding these changes that take place even in real time. But again, oftentimes, like for myself, I'll see a setup and it could be as simple as a flat base breakout. And oftentimes I'll try to buy that flat base breakout, and it doesn't work and it fails. And then I try another one and it doesn't work and it fails. But I've seen the success of it for so many years that just because it's not working, right, all of a sudden I'm looking at the daily chart, and a stock, the setup that is working is you're looking at like a left side on the daily, a prior support area, and price is just undercutting that level and then rallying right back through as an undercut and rally setup. And that is working, right? So sometimes selling into supply, right, versus trying to buy a breakout oversupply is what's working. And sometimes buying that area of demand as an undercut and rally is what's working. Sometimes buying a higher low setup on the daily is what's working. Sometimes buying EPs is what's working. Sometimes waiting for delayed setups is what's working. So as Stan was saying, like expanding that tool belt. So if you think that your edge is eroding, right, it's because of the market cycle, not because of that particular edge itself. It's just that the edge in that moment isn't what's working. But yeah, if you're into Chinese small caps with low floats, they're not always in favor, right? Particular sectors aren't always in favor. If you want to be long stocks, that you think are undervalued, but they, for me, are under the 200-day, right? I have no edge there buying it, looking at the fundamentals of a business and saying, oh, they make tons of money, good earnings and sales, but they're below the 200. I'm effectively arguing with the people who can actually move the stock that I buy, right? Unless I'm going to be accumulating hundreds of millions of dollars of this thing, and I'm not, right? I'm expecting institutions to show up and do that, and they're doing that with stocks that are in uptrends, leading groups, right? Leading industry groups, top 40 groups, and there's 197 of them. So it's like my edge really comes from expanding my own playbook and having an understanding of I'm not a Warren Buffett, right? My edge doesn't lie in, with a 30-year time horizon and buying companies that I believe to be undervalued, right? That's how someone ends up in Moderna at 250 after it just got sliced in half. And then it gets sliced by another 75%. So it's like my edge doesn't lie with stocks that are in a downtrend. My edge lies with stocks that are in an uptrend. But even in an uptrend, what are my entry tactics? Where does my edge lie? And then when I notice that my edge isn't working, it's not because it will never work again because I've talked about a flat base breakout or a higher low setup or undercut and rally, right? Which is typically the few ways that I like to enter stocks, right? But it's just that in that moment, right, how is the health of the groups that I'm trading, and where is the market at in particular, right? I hear all the time people will say, oh, the market looks terrible. And then to which I say, well, what market are you trading? Because you might be trading a choppy NASDAQ and I'm focused on gold names, right? And gold has just been in a beautiful uptrend for a year plus, right? Very little headache. And so again, that just comes with the expanding your playbook, knowing where you want to be. And when your edge isn't working, having that other setup for an entry or for a short, right? Having that in your playbook. And the market gives really great feedback. When your setup isn't working, and I like buying a flat base breakout, or, sometimes just a high type flag, like letting the stock run up for a few weeks, letting it build out that small base, 3 to 5 to 7 weeks, and then rebuying that breakout. So I saw the strength, I see the accumulation, I have a low risk entry. If then that begins to fail once, twice, 3 times, it's not because they'll never work again. It's because in this moment in time, these aren't the setups that are in favor. And I've had this discussion with other traders before. Sometimes the theme is the setup. Like sometimes we see stocks coming way off the bottom, whether it's bankruptcy plays, and then it's stocks that were like, oh, they're going bankrupt, but then they go on these multiple 100% moves. Well, that worked for a period in 2020 and 2021, right? Or other times it's just a particular theme, whether it's solar, whether it's EVs, and the edge is just recognizing this is the theme in favor, right? And not the theme that, or not your edge and saying, oh, I'm finding value in these cheap companies because they've come down 50%. So my edge is just buying companies that I think have great value and then expecting that. For somebody might be edge, but there are moments and times in which that edge for you does feel like it's eroded if that's the only thing in your playbook. But being able to recognize it isn't working right now, right? And what else do I have for entry? Because if I'm a long bias trader, and you like EPs and EPs only, sometimes they gap up and they fail completely. Like, AppLovin's been on this huge run from $10 to $500. And just this most recent gap up, and it's had several within its run, these several bullish continuation on earnings. And then finally you go to, I'm an earnings gap up buyer. Okay, fine. And then the day in which you buy a late stage, earnings gap up, it just completely fails all day long. But the next day it just ramps right back all day long. So it's like, having entry tactics for setups is very important. And it's not, again, that your edge, because you've told it to somebody, is just going to erode. Now, to your point, if I'm a Chinese small cap trader and these things only have 2 million share floats, it doesn't take many participants to potentially ruin an edge. But then recognizing that in real time, like, hey, this is what I used to do with liquidation plays. And then it's just not working because there's still wash selling going on. It's a wash sale and then it's just being accumulated and it's just like 1 or 2 players soaking up the entirety of the float. And then when they want to exit, you finally get your liquidation. So yes, there's some caveats there, right? Depending on the float, but for the most part, there are 13,000 names to trade, and there are entry tactics that work better than others in certain environments. So recognizing what's working today, may not be the thing that's working a month from now. And for me, it really just comes down to where we are in the current market cycle, right? If you're coming out of a big, long, drawn out bear market, I actually find it the best time in the world to look for stocks near 52-week highs, because the only reason that they're at 52-week highs or all-time highs is because institutions haven't let them go down, right? So finally, when the market turns, if you're looking at the NASDAQ or the S&P 500, we'll just call it the NASDAQ, and you've got a stock near 52-week highs, and the NASDAQ just had this 18%, 20, 25% drawdown over the last 12 months. A stock at 52-week highs should be screaming relative strength. Now it's just how does my edge get me involved within this stock, right? Whether it be its own earnings gap up, a high type flag continuation setup, an undercut and rally, a higher low on the daily where it just like pulls back, bounces off a 10-day moving average, and then continues higher. Right? And so what is your entry tactics? What is your edge? What's your expected value? on buying this sort of setup. And in some markets, there's better expected value on certain entries, right? If a stock's getting stuffed right at supply level every time, and you notice that, the expected value on plays like that when you should really be selling into supply is low. But if buying undercut and rallies is the thing that's been working, there's much more expected value in that entry, and there's much more edge in that entry at this particular time within the market. So I think just recognizing that is like such an important part of any trader's journey effectively, right? It's like knowing a few different entry tactics, right? Or short entry tactics for the market environment that you're in. And yeah, I mean, I would almost, die upon those words that, that's how any trader should be viewing the market, right? Dynamics are constantly changing. But if you go back and study EP setups, right, throughout the history of time, whether it's an upstart in 2021, right, where it gaps up 160 and then basically runs to 400 over the course of a few quarters or a few months, or whether you look at Elf Cosmetics or Abercrombie, right? Once these things have a good gap up, right, they're timeless. The entries are timeless. But how do you get involved where your edge says it's a low risk entry? And then is this the market really that's conducive to that edge? It's not because I just told Chris about it and Nick about it and Stan about it that now market makers or institutions are like, yeah, we're not going to let that work, right? The reality is if it's not working, it's because of the environment that you're in, not because you've shared set edge.
Yeah, and I think something that you mentioned here, Ariel, is more so the market. It goes through different cycles. It goes through different themes. Just like you said, hey, we've seen a cycle where a company files for bankruptcy and then it runs 600%.
Yeah.
You're like, what? So then that after a while that stops working. Then just a few months ago they go through like the sub 75 cent tickers. So because sub 75 cent close, then you have the halt. The close halt time bands. So it makes it easier to control the move, right? So then you go through like a 2 to 3 5 week period of sub dollar moves.
Where that's working well.
Right. Then you go to, then that shifts into another cycle of the, $1 to $5 names now run. Now they go to 7 to 10. That shifts, then it goes into a different cycle. So I still remember to this day, one of my mentors, that what he said early on, he said, the more adaptable you are, the longer your trading career is going to be. He didn't say anything about edge. He didn't say anything about get in here or what size or what rules. No, that's it. The more adaptable you are, the longer your career will be. And it doesn't mean you're going to necessarily be successful right away, but what it means is you will be exposed to the various market cycles throughout time. And guess what? They start to repeat after a while. Yes, they look a little bit different because now we have Chris in the play, we have Nick in the in the play, we have more participants in the market. So the overall supply and demand dynamic is a little bit different, but the structure of it, how it works, is the same. And I believe that's the to me that's been key is if I find myself trading a particular setup and then it stops working and I'm like, okay, what I have done is I have failed to adapt quick. That's the only thing I've done. It's not the market's fault. It's not the ticker's fault. It's not that it's a 2 million float ticker. I already knew that, right? It was a 2 million at the beginning of the day before I started trading it. So I'm already accepting, the moment I enter the trade, I'm accepting that possibility, right? That change, that adaptability. And I think for me, that's what it comes down to. The quicker you're able to adapt, the longer your career will be, because you're just exposed to all of the different variables.
Yeah.
It's dynamic.
Yeah. In terms of adapting, if you had to give somebody who thinks that their edge is eroding, if you had to give them sort of a playbook or some advice on what to do next, if they firmly believe their edge is eroding, what would you tell them in terms of getting out of that mindset, or what's the next step? It's not going to be necessarily just stop trading. Like, what do they do from that point?
Yeah, I mean, I think you really got to take a step back and review your trades and see what you're doing wrong, right? Like what has essentially stopped working for you, and then you can come to the why. And once you get to the why, you can come up with a million solutions of how to, fix that, whether it's changing your size, waiting a little longer than you normally would to get involved in a position, so entry and exit points. But yeah, it would be a lot of back testing and take a step back and really figure out what's not working for you.
Yeah. What would you say to them, Chris?
Yeah, I think what helps is to go back to almost like first principle thinking. So instead of saying, someone is a China liquidation trader, it's like, well, no, you're either long that or you're short that. So what are you? I'm maybe more of a small cap, long trader. Okay, or a small cap short trader. Okay, and then go back a little bit further. It's like, I'm looking for a large imbalance between supply and demand due to these factors. And so if you, instead of hanging out at the end result or a very specific example of what you do, go back further to first principles, and that will help you. So for instance, like Ariel was saying, some markets breakouts don't work that well. Okay, and if someone identifies as I'm a large cap earnings breakout, trader on the third Friday of the month and under these conditions, it's like that's so specific that can change a lot. But if you scale it back and say, I'm more of a long bias trader, I'm more of a swing trader, I like supply and demand imbalances when there's usually fundamental news or something that increases the fundamentals of the company, and I like to participate in that new demand coming up, then if you have a more rooted example of what kind of trader you are, you can find different examples, because instead of being a small cap, very specific, earnings breakout trader, you could be, someone who likes to participate on the long side in big moves. And so you could wait for, maybe it's not an earnings catalyst, maybe it's another kind of catalyst. And so you can look for other examples in the market of that. And so I think that that's super helpful, because it takes your mind off of my edge is eroding to this example of what I like to do is changing, but there's many other examples of that same thing that I can do in different ways. And, it's not like in bear markets, there's no such thing as making money on the long side. It's not like in bull markets, there's no such thing as making money on the short side. You just have to find the pockets where what you like to trade, where you find edge, and where there's a supply and demand dynamic that you can understand and participate in is showing up in a way that you are able to understand. And that might mean adapting, that might mean learning a new manifestation of your strategy. But, to say that, pigeonhole yourself into this small niche under these such specific conditions, the markets are always adapting and changing. And so that will pop up somewhere else, but it's going to look a little bit different.
Yeah, and kind of tongue in cheek too, Chris, like you could still be a bullish trader in a bearish market if you just play inverse names. Right? There's still, but the price structure looks very similar, right? I sometimes will joke with people who will, I'll look at what bullish structure looks like, right? And that's price having gone up, being above its moving averages, having gone sideways. And a chart will look bad, and I'll flip it upside down and I'll say, does that look good to you? And I'll share it with somebody who's a bullish trader, and they'll be like, oh man, that looks great. I'll be like, that's XYZ chart flipped upside down, right? So in fact, it doesn't look good, right? It looks like it's gonna go lower. But if you flip it upside down, it looks like a bullish chart, or literally playing an inverse ETF to a particular stock. So yeah, and even still, it's like when I take a trade and it doesn't work, that's the market giving me valuable feedback. Not because I haven't seen bullish breakout, flat-based breakouts, high or low setups work before. They work often, but what kind of environment are you in? And even when the market gives me that feedback, that's just one trade. I take another and it fails. That's just another trade. But then throughout my own homework in the evening, when I am scanning the market, I go, oh, all these stocks had really nice high type flags. They gave you your flagpole, they consolidated for 3 weeks, and then they all failed, right? And as I'm scanning, it's not just the 2 setups that I've taken that have failed. It's through my own scanning that I see these others are failing too. But they may be getting bought up at support, right? Maybe the bottom of that base. And that's something that I notice after the fact, but then I go, hey, maybe that's kind of the environment that we're in right now. So when I see a chart coming into an area of demand, right, just based on the daily chart, they're holding, and then I've got an entry tactic for that, an undercut and rally, right? And so it's like having something that you're equipped to do based on what your eyeballs are showing you, right? And not just applying my opinion and saying, well, this is the only way I like to trade. Well, if that's fine, then you have to wait for that environment. And there's going to be some moments when you feel like a genius because your setup is working perfect. And then, I became a swing trader in 2022. So outside of me swing trading energy stocks, the rest of the year, my edge on buying breakouts was terrible, right? And so I had to learn some shorting. I had to learn different entry tactics, undercut and rallies, higher low setups, EP gap ups. Like I had to expand my own playbook just to still be able to participate in the market. And it's not that you can't do well. It's just that you have to recognize, like, I've now gotten stopped out of my last 5, 6, 7 trades. So our breakout's never going to work again. And then you get into 2023 and 2024 and breakouts, they break out and then they're moving 30, 40% in 2 weeks, right? So again, it's not that your current edge, just because it's dissipated over the last few days, that, you know, that edge will be eroded forever. It's just that currently, you know, when a stock reaches supply and you're a buyer over a supply level, it's stuffing, right? And being able to recognize that in real time, and even through your own trading failures, being wrong, you recognize that, and then having something else you can go to get yourself involved in the market and studying that price structure of what that looks like upon your entry, right? It might look a certain way on the daily, but then maybe zooming in onto an intraday level to get a little bit more granular on a 5-minute, a 30-minute, 15-minute chart to say, this is my entry tactic, maybe back through VWAP, maybe when a few moving averages cross, whatever it is your entry tactic might be to limit your risk, and finding that new edge that the market is providing, because there's always an edge. You just have to learn what is in favor today and what isn't in favor today.
Yeah, and if you have a really strong opinion on that, I think one of the worst things that ends up happening is you actually miss an opportunity to learn something great. Because if you believe that you're trading a certain setup and all of a sudden the setup has eroded and you're like, well, the hell with this thing, I'm never touching it. Give it 6 months, and when the cycle is back in play, guess what? Everyone around you is making a killing, and you're like, no, this is no longer working because it had eroded. No, it didn't erode. It's just, it wasn't its time. But if you're able to be open to that, right? To just be open to the possibility that maybe it's the market cycle, maybe it's not me, right? Maybe it's not edge erosion, maybe it's just not the right place, right time, because that's what trading is, right? Trading is aligning all of these dynamic variables and picking the spot when they're in confluence. That is your edge, because now this is something that you can identify. That's your trigger. Doesn't mean it's going to be a profitable trade. I don't know. I can't predict the future. But what it does mean is that this was your trigger. And this is where risk management steps in. If it goes the other way, then you cut it. If you suck at risk management, then you won't cut it, and then you're probably going to blame the ticker again, right? So I think that's the really missed opportunity there is, if you're so focused on, okay, this is no longer working because everyone knows about it. I'm not so sure if that's true, because it takes a lot more to trade than knowledge. You can have and have read and watched all of the books and videos on trading ever, twice, slow them down, watch them 5 times. But unless you actually go in there and you start executing, it is all a theory. It is all a theory. And there's certain lessons in trading where I don't care who they have happened to you. If you have not personally been through them, there's no value. You can't learn. You can't read a book about risk management. Yeah. I'm sorry. That's going to give you the technical aspect. That's going to give you the theory. But risk management is, again, like anything else in trading, it's dynamic.
Yeah, yeah, and that's a great point too. I mean, I feel like we could go on for another whole segment about edge in terms of your own emotions, because there's technical edge, and then there's sort of a mindset that you can have, right? If you're trading on tilt, you're, you know, regardless of what the technical setup looks like, you're probably not in the right frame of mind to be anywhere near your account and trading your account.
To that point, Anthony, I think momentum trading, which is a lot of what I do, right? You know, I trade momentum. I'm interested when there's range, volume, liquidity. That's what interests me. I don't care about the cap or the stock or ticker. So in momentum trading, I believe that is of great value to take and say, I'm trading the opportunity in front of me. I'm not worried about the 50 that I missed or the 20 that are upcoming, right? I'm trading what's in front of me.
Yeah, and that's something that I see, Nick, when you do morning broadcasts or your watch lists, and Chris on Sunday Scan, I'm noticing across IU, regardless of what happens in the market for that day or that month, I see you guys constantly finding and implementing edge in the market. And so I think it's a decent thing to throw in there for people, which is like, if you're part of a trading community, if you're part of IU or somewhere else, you can be talking to other traders who are doing well in the market and bounce ideas off of them. Why am I having issues with this particular trade, and get some of this information, this feedback in real time, from other traders in the community, as well as what you're getting, feedback from the market as well. So just wanted to mention that. Yeah. Any last notes
to that point, I'll just mention this one thing. I don't think there's ever been a single day where I've logged into Investors Underground and someone hasn't taken a trade.
Yeah.
Like, regardless of what the market cycle is, or there's no way, right?
There are long bias and short bias traders.
And that's the beauty of it, is it's just such a buffet of offering, to where you just latch onto who you align to best as far as risk appetite, risk management, tolerance, all of that stuff. Yeah, absolutely. Thank you.
Awesome. Yeah, thank you guys so much.
Thank you.
Yeah, for having this conversation.
Appreciate it.
It's great. And hopefully this conversation was helpful to you out there. We'd love to get your feedback, so feel free to leave a comment. Thanks for watching. We hope you enjoyed this episode of The Trader's Journey. We have additional episodes we believe you might also like, so don't forget to subscribe. You'll be notified of upcoming releases the moment they're available. Thanks for tuning in.